Very good, yeah.
No, it's alright for you. When did you get it yesterday? Where you staying? Use it for actually have to get
Nice one, Pat. I didn't realise it was the accent.
I got here yesterday, so Malcolm Jen last night registered and she's over where all the places were, and then my first one to know that you were so is it alright? When was the first one last year? I know it's sort of you want to sort of work out how it all works. So you're meant to look at it now, isn't it?
Was that EA?
Right, okay, so yeah, it's not being able to keep it anymore. Yeah. It's a question. I've come with Jenny because she comes as the member to learn and teaching so when do you plan to spend on well, so they let me join the fight back to it's a hush. We've lost a panel member. Oh, fine. She was 2 people behind in the queue, and from that queue she's disappeared. Yeah. She's on the wrong panel, with the wrong question being put at her. We'll just give Raeesa a couple of minutes.
Yeah, no, that's it. Tapping page. Yeah, no, I'm not back for it, but I've got that something. Like 6 weeks. Yeah. Yeah. It's just an introduction one, isn't it?
Right. Well done. Thank you. I knew you were here. Yes, I thought I'd go. You blame Jim.
Just check out this Raeesa. Yeah, cheers, thanks. Oh yeah. They watch that as well. They're like, oh, just it's fine. Is there an island? And then there's one silent. So it's tried everything there, but then I drive on like full whack and just like make with the feet and stuff. Okay, good morning, everyone. Thank you for joining us on this early Monday morning in Monte Carlo. My name is Richard Burrows. I'm an IRLA director, and we're here today for the panel session on legacy solutions for reinsurers. Just some general housekeeping rules first. First of all, the session is being recorded, so please bear that in mind if you are asking any questions and when you're deciding what language to use. I've spoken with the panel and we decided to collate the questions at the end, so if you do have any questions that you wish to ask, please ask them at the end of the session. There's also a number of IRLA directors in the room. There's myself, Kevin, Paul, James and Jenny. So if anyone does have any questions about general IRLA membership, then we're happy to discuss that at the end as well. So today's panel is going to be discussing the tools and solutions that the legacy market professionals can offer to live operations as a business partner, and IRLA membership is also open to live players as well. So on the panel today, we've got Raeesa Chowdhury, a partner in the corporate team at DWF's London office, Andy Creed, Group Chief Financial Officer at Riverstone International. In the middle, we've got Kevin Gill, a partner at EY and also Chairman of IRLA. David Flandro, who is Head of Industry Analysis and Strategic Advisory at Howden Re. And finally, we've got Nick Crossley, who's CEO of Enstar EU. So I'll now hand over to the panel. Thank you.
Thank you, Richard. Good morning, everybody. Very warm welcome and thankfully a dry welcome this morning to IRLA's panel on legacy solutions for the live market. We'll look at the solutions the industry is offering to the live market by looking back at the last 12 months to see what's been going on. We'll take a look forward to see what we think is going to go on in the next 12 months. We'll look at things that are on a geographic basis, what's happening around the world, and finally, if I can navigate the panel successfully through 40 or 50 minutes, we'll look at what the market is doing to make it sure it is attractive to capital and its client base. And this time last year, we were sat here at the inaugural panel talking about how buoyant the market was. There was plenty of transactions going on, but I think the past 12 months is somewhat quieter than that. So maybe we can start the first questions to the panel about what has been happening in the last 12 months. Maybe we'll ask Nick and Andy to go first, who are practitioners in the marketplace. Nick, you want to kick it off?
Can you hear me? Fantastic. So the question is, what's been going on over the last 12 months? Why has it felt a bit quieter? Actually, I'd probably look back with a bit of context at the last 4 years or so. And I think it's fair to say that we've really seen an uptick in the volume of deals being presented to the market. We've certainly viewed something like north of 60 deals per annum over the last number of years, and that continues at a similar kind of average. Now, that's in terms of deals that are being presented to the market. And of that, about 86 billion over the last 4 years. So we're talking significant volumes generally. The health of the market, I think, is very strong. It is true when you look at a market level that there's been a lower conversion rate, completions. So from that volume that's been presented, deals actually clearing the decks and transacting at a market level have gone down somewhat. And there are probably quite a number of nuances as to why that is. I think if you look at lines of business, we've seen particularly kind of US casualty exposed portfolios struggle to trade in some instances, particularly where there's a difference in view between buyers and sellers on whether the soft years are marked to market and how the more recent underwriting is actually starting to perform. I think we're probably seeing some cases of good news being banked a bit early for our liking, but it is very different depending on cedants. But certainly that has led to a little bit of an increase in the bid-ask spread on some of those portfolios. And then I think the other piece to think about when looking at the volume of deals that have been completing is particularly the kind of mid to smaller end of the market. There's been some issues with capacity in the market amongst some of our competitors within the sector who traditionally would have mopped up a significant number of volume of deals. So maybe that has something to do with it, albeit I would also say at the smaller end of the market, a lot of deals are done and not necessarily reported upon. And then when I look at the larger deal spectrum, we continue to see, I think, a very healthy flow of deals being brought to market and actually clearing. The number of deals in excess of 500 million that we've seen over the last 4 years has doubled. And actually the number of deals in excess of 1 billion has doubled. We at Enstar a couple of years ago did a north of 3 billion transaction with Aspen. since then, we've just continued to see a significant number of 1 billion plus transactions. I think at any point in time, there's at least one or two in the pipeline. So I think the fundamentals of the market, despite what you may be reading in the headlines, are still very strong. The nature of the demand is very strong, and I'm sure we'll get into reasons for that as we go forward.
Thank you, Nick. Andy?
Thanks, Kevin. Thanks, Nick. So I think Nick picks up on quite a lot of points there on the reserving side and in terms of the capacity in the market. So I'd just make a couple of other points. So just starting in the Lloyd's market, really, where we obviously have seen a drop-off in Lloyd's activity, and I think that's just coming off the back of a spike, which is something that Nick has referred to, the Decile 10 and performance management review that had been started by John Hancock around 5 years ago, had obviously driven a significant amount of transaction activity in that space, and that was inevitably going to come to an end at some point. We are starting to see that pick up, which is good, and we'll touch on that again later today. I think the other angle as well is to think about it from the cedent's perspective and, in fact, the live market's performance as well. Obviously, the legacy market is there to provide solutions throughout the life cycle of the insurance market, but in particular over the last couple of years, the performance of live carriers has clearly been much better than it was towards the end of the 2010s and into the early 2020s. Which clearly leads people to think about things from a different strategic perspective in terms of what's going on and what they need to do to try and find those solutions. One other observation that I would pick up on and think about as well is the impact of interest rate rises coming through in the post-COVID world. So that has had a significant impact on a number of insurance balance sheets globally. The unrealised mark-to-market losses that those life carriers would have been taking has left them with fixed income portfolios that are clearly below the waterline, and most, they would sit there and say that that's fine. They're all going to unwind to par over time, which is certainly something we would expect. It can change the appetite of cedents to pass over bulk premium in those situations. So that can change the appetite of the ceding market to look at things in that way as well. There are ways that the legacy market can solve for that, and the legacy market is being very good at offering structures and solutions regardless of the active market, and it's one of the benefits of this space really that it continues to provide solutions throughout different recessionary and or inflationary environments. It is relatively recession proof, and the legacy market is, and I'm sure Nick would say this, very good at structuring transactions to provide solutions where there are challenges like unrealised mark-to-market losses on portfolios, and we've certainly enjoyed trying to do that over the last few years as well.
Thank you, Andy. Raeesa?
Yeah, I haven't got too much to add because a lot of the points have been covered, but just generally from an M&A perspective, transactions have slowed quite considerably. I think in the last PwC Global Runoff Survey, 120 transactions came to market, only 30 closed, and they were the larger transactions. We've definitely seen a slow up in M&A generally in the market, and I think that's also impacting legacy. What we've also seen is we act for a number of the live market, and we were doing a number of Part 7s, and all Part 7s collapsed at the same time, and people just decided we're not proceeding with that because the PRO was taking too long with providing approval to the transfer of those liabilities. So we've seen more reinsurance transactions come to market, so LPTs, ADCs, and the like, mostly LPTs, I would say, and just, the legacy market's been providing more reinsurance solutions to ensure that the live market can, transfer the liabilities and get them off their book that much quicker.
Yeah, I agree, Raeesa. There's definitely a shift towards reinsurance, and they're not always disclosed. David, perhaps from a macro point of view, you can look at what's been happening.
Okay. Yeah, I was. Funnily enough, I can speak to the micro on this one too. I was just trying to sell an ADC on, was it Friday night? No, yes, Friday night, because I had to go pick up the brochures to bring them down here, and I met a client in London to try to sell them an ADC. We tried to quantify it in terms of the value of their firm, their publicly traded firm. But yeah, if you haven't guessed, I'm the macro guy. I'm the guy who's not the direct practitioner in the market. And it's just interesting to listen to all these guys talk because, of course, there are parallels with the rest of the reinsurance market. And the story of the last 24 months, is that kind of when you guys have been saying that deal flow has dried up, or is it just the last 12 months? The story of the last 24 months really kicked off here at Monte Carlo 2 years ago. And right after this, we had Hurricane Ian. And then this was in an environment, I think, as Andy mentioned, where interest rates had gone up by 500 basis points. No economist predicted this. Inflation went up by far more than the economic community predicted. The reinsurance sector lost 17% of its dedicated capital that year. Okay, so that's going to have a massive effect right off the top. And then it, as you say, Andy, the reinsurers protested and said, look, these are high-grade, medium-duration fixed income securities that we have in our portfolios. They're going to pull to par. And of course they have, and so we're back. The trouble is that had we had a Los Angeles earthquake in the autumn of 2022, they would have had to sell those fixed income securities at a loss, and everybody knew that. So there's been a lot of capital volatility in the last couple of years that we just haven't been used to this since the financial crisis. Even during COVID, everything, asset values were buoyant, interest rates were low. That will have had a really big effect. Another effect is that the reinsurers that write those ADCs and LPTs and the insurers actually even that are ceding are making a lot of money post that environment. I don't know if we're allowed to say this, but we are creating more economic value add in the insurance and reinsurance sectors than we have for a really long time. Economic value add, just your return on capital minus what it costs to finance your business. And as a result, if you equal weight the share prices, for example, of reinsurance companies and compare them to the MSCI World Index, we're winning. So you're right, Andy. A lot of cedents are looking at their books and going, gosh, maybe this isn't so bad. And so that makes all the sense in the world, Raeesa, that the main tool that would be getting used right now is just capital optimization as opposed to complete capital transfer. Probably in my world, we're seeing more ADCs than LPTs, but maybe that's just a function of where we sit. And that's been quite an active market recently, but it's not because of distress. It's not because people are trying to sell off their reserves and they're worried about it. It's about capital optimization. And then just finally, a word on casualty. This is the thing that everybody's talking about at this Monte Carlo, and a little bit last time as well. It was starting to burgeon. The year before, everybody was worried more about property rates. But casualty in the United States, OLCM, OLO, reinsurance liability, and commercial auto liability have been deficient in accident years 14 to 19, and more recently commercial auto liability. The rest of the book is redundant, even in the U.S., particularly comp. So that's a bifurcation that we're coming to terms with. And I think that there was a headline this morning on one of the publications saying, we are getting more comfortable because we're actually making money on casualty, even as those accident years get worse. If you look at a calendar year basis, we're still seeing net releases on a calendar year basis. So I guess that the reason maybe if there's been a slow in deal flow is just because the market's going through a cyclical shift, and it's people in the market are just trying to get their heads around it.
Thank you, David.
Yeah.
I'm wondering now whether I get Andy and Nick to look forward 12 months, or do you want to kick off with your view of 12 months? Maybe I'll ask Andy. Go on, Andy. What are you looking at next 12 months?
Yeah, thanks, Kevin. So, I mean, look, my overarching view is there is going to be an increased deal flow now. I think we're going to come out of the back of the slowing cycle. I think we've got reserve stabilising, which David has just alluded to. We've got interest rates stabilising and returning to a longer-term mean average, which is, I think, helpful from a transactional point of view. And we've got, in theory at least, better reserved 2020 and plus years, which I think the legacy market could, if the live players start to think about it, help those incumbents extract value from going forward. And that combined with 14 to 19 reaching perhaps a level that people feel more comfortable with will help deal with some of the challenges that Nick referred to earlier when he was talking about bid-ask spreads being too wide for transactions to close. I think alongside that, and I've kind of alluded to it there, certainly the legacy market has got much more comfortable at doing this in recent years as it's sort of narrowed the gap between where it was traditionally and the actual reinsurance market is a continued appetite for younger years. Certainly from where I sit, we've got comfortable taking on younger years in recent history and as well as unexpired in many cases. So we will look to take that on where it makes sense, and preferably where it's part of a diversified portfolio that allows us to offer a solution that is holistic and all-encompassing to the market. I'll just touch on capital a little bit and deal structure. So I think we saw a transaction earlier this year where Longtail Re came in from behind Markel and to reinsure James River. So it's very much a structured reinsurance transaction with new capital coming into that space. It's a private equity player sitting behind that transaction, very much interested in picking up the float, which I think is a slight change from what we've seen in more recent years and perhaps back to where we were in some of the earlier life cycles of the legacy market. So I think we're going to continue to see capital flowing in. I think we're going to continue to see the transition towards some structured reinsurance, and that will help move the market forward again.
Thank you, Andy. Nick?
Sorry. So I'd say looking at the next 12 months, I think much like Andy, I continue to be very optimistic around just the underlying drivers, the flow of deals, the quality and nature of deals coming through the pipeline. A lot of what Andy touched on, I think, harks to the fact that as an industry, we have moved from offering tactical solutions to strategic solutions, and people say that a lot. My interpretation of what that means is, we're helping, on the one hand, counterparties manage their risk, kind of from a risk management perspective, manage their capital, recycle capital, manage their operations. So it's much more holistic. And then add to that the fact that we can help cleanse balance sheets ahead of M&A activity or strategic initiatives. What that really means is we're in the heart of supporting our counterparties in defining the strategy, executing their strategy, and supporting their kind of broader investor story. And I think with that, with this kind of more strategic deals, what that means is the deals are, one, they're larger, because we're talking about supporting capital relief. Capital tends to be concentrated in more recent years. More recent underwriting, again, as Andy touched on, spells larger deals. They're more complex, so the kind of nature of the solutions that we're continuing to evolve into, I think, is very clear. We're able to splice and dice the liability side much more effectively than we used to be once upon a time, and that's only continuing. We're able to deal with assets in different ways. We don't necessarily take the assets on. We might do funds withheld structures. We might do a range of alternative structuring around the asset piece, not just to deal with unrealized losses, but any broader needs that our counterparties may have. Operations need to be scalable, flexible, to be able to deal with deal flow from wherever it may be, and again, be able to offer a comprehensive solution to our counterparties. So that the nature of that evolution is very clear. The market is very much continuing to gear itself, not just over frankly the next 12 months, but beyond that to support that evolving demand. I think over the next period, we'll continue to see new markets opening up as well. I think we'll talk about jurisdictions a bit later, or new markets in terms of products. At Enstar, we've broken into the IRLA space this year, offering solutions to investors with trapped capital in some of those collateralized reinsurance structures. And that's just an example, but there'll be many more, I'm sure, as we'll look to the next 12 to 24 months. And then, I think with the nature of the demand, where the market is going, there is a flight to quality. Cedents want to be able to deal with counterparties who've got a long-term commitment to the market, who are robust, resilient, who've got access to capital, and who are creative and innovative. And I think that innovation, the market's been known for it, and we're only seeing that continue apace as we look at the market right now.
Thank you, Nick. Raeesa?
Yeah, I've just got 2 points to add. The first is ESG, which is a massive buzzword, but there's a lot of regulation coming in, specifically for large corporations, because they'll have reporting requirements under ESG regulation. So I think what this means for the live market versus legacy market is we may see more deals where the live market says, okay, I've got these objectives to fulfill in terms of my ESG, my net carbon emissions, et cetera, et cetera. I'm going to offload these books because that's not what I should be writing now in order to meet those targets. So we may see more deal flow there. The second point I wanted to make is on third-party services. So what I've seen in the market recently, definitely with Marco Capital, is they've got a third-party service offering. I've seen it with a lot of my MGA clients as well. Broadening and diversifying their portfolios so they're not relying so heavily on M&A and transactions. And we may see more of those offerings from the legacy market and legacy market players as they look to diversify.
Totally agree, Raeesa. David, 12 months ahead.
All right, 12. What's going to happen in the future, right? I can't remember what Yogi Berra said about the future. It's too early, but you know, I don't know how much I can add to what these guys have already said. If I want to Nate Silver it, I think I could build a 5-factor model here. I could say, as Andy said again, I'm just going to repeat what you said, Andy. Inflation is moderating. Maybe slower than central banks would like, but it is moderating. Interest rates are moderating, even though we had the crappy employment report. Interest rates are moderating. Capital and capacity are buoyant now. And then there's loads of I mentioned share price appreciation. These companies are making a lot of money. They're creating a lot of economic value. It's hard to go to your seat and when you're printing an ROE of 25 and say, you know, my 2014 accident year looks bad, so you have to pay more. So maybe the bid-ask spread will narrow a little bit. And then the other thing I would so those are all things on the positive side, and this is actually a model that we think about internally in my shop. The fly in the ointment on the negative side is the casualty conundrum. We still hear a lot about casualty from reinsurers, and we're hearing it a lot at this conference, how bad those accident years are and how much they need to still be remediated. That will play out over the next year. Are we in some kind of mini crisis, or is this just part of the normal reserving cycle? And once we get past that, I think that deal flow really should unlock. On the plus side of that casualty conundrum, you know, unlike last time during the liability crisis where we didn't really find out just how bad it was until we were almost done with it on an accident year basis, this time if you look, for example, at first year percentage IBNR levels in the United States, you can see them rising even in line with pricing starting a few years ago. So, if you will, actuaries were taking remediative action on casualty quite early. It's now coming through on a calendar year basis for 14 to 19, and even post-COVID on commercial auto liability post-22. The thing is, we just got so used to reserves always just being redundant all the time for about 10 years because we were in that environment of quantitative easing and disinflation for all of those years. And so, you know, the discount rate was low, but we could release reserves because the actual reserve balances themselves were coming down because of disinflation. We weren't ready for that big change in 2022 when interest rates spiked the way they did. And again, I know this sounds really simplistic, but we're just back to a normal cycle where we have a series of deficiencies and then a series of redundancies and then a series of deficiencies. It's a cosine wave. This is normal. We can track it going back to the 30s. It's nothing new, but it's new for us in the last decade and a half because we had this post-GFC quantitative easing. That's over now. And so I think it's just a matter of just getting through this kind of reckoning period, and then deal flow should resume.
Thank you, David. So in the last 12, 18 months or so, IRLA have set up a Bermuda outfit because we see a lot of our market are operating on a global basis. And I just wonder if maybe Nick and Andy can just reflect on where they see the global activity going on.
So it's a very long question, so I'll try and be very brief, just highlight some key markets rather than go too deep. In the US, we've got a significant activity there. We have for a long time. I think we're starting to see a bit of an uptick in workers' comp opportunities. I think you mentioned, Dave, the workers' comp market has been, very profitable for many years, lots of releases that have benefited carriers, not least across fund, perhaps some less profitable lines. Question mark on more recent years. There has been some pressure on rates. Some are going down in some states, and so I think we'll need to see how that plays out going forward. The IBT market, we'd still like, we're still encouraged to see more states adopting that structure as a means to transfer liabilities. We want to see and hope that over time that will genuinely create a head of steam to be able to transact much more regularly in that space. Corporate liability markets, potential opportunities coming through. We've got more clarity now from the BMA on what they expect from a capital perspective under BSCR in terms of how to manage some of those processes. So I think certainly for the Bermuda headquarters players, that gives some clarity to be able to lean into the markets, and we're certainly seeing some brokers try and generate opportunities in that space. Bermuda is very much at the crossroads of a global market, so there always is activity. You know, a lot of global balance sheets are reinsured into Bermuda, so no doubt we see a significant buoyant activity on large, specialty portfolios, diversified portfolios. I touched on the ILS opportunity as well, which I think is a space that the sector needs to spend more time on. Lloyd's, we've seen a bit of an uptick, which Andy touched on, both of standalone Lloyd's transactions and transactions with a Lloyd element, but multi-platform deals with a Lloyd's element attached to them. Lloyd's is scrutinising legacy deals generally, has been for a while, and we welcome that. We think that fundamentally is very positive to create a strong and sophisticated market. In the EU, perhaps I think continues to be a slow market, certainly from our vantage point. We see deals tend to be fairly small. I think perhaps the EU market is continuing. It's not true for all players, but many are continuing to engage with the market more on that kind of tactical basis rather than generally on a strategic basis. So I think there's a big job for all the market to come together and educate counterparties, for intermediaries, brokers, to spend time. I think they're educating boards as to what the opportunity really could look like if they targeted it differently. And then Asia Pac, Australia is a market that keeps giving. We've seen a lot of opportunities there over the years. Again this year we signed a transaction with IAG. We see demand from the larger players, but also quite a broad breadth of some of the niche players, some captive markets. So a number of themes there. And as for Far East Asia, we haven't really played in the market, if I'm honest. We have seen a number of opportunities. They tend to be a little bit bitty. Regulators are less experienced at dealing with legacy. So I do believe that it is worth spending time there. We are keen to get there in time, but it is a kind of a slow moving one to keep an eye on. So I'll stop there.
Okay, Nick, you took more than 2 countries, right? Yeah. So you left for Timbuktu, I think, and somewhere else. I was trying to keep... Anyway, you have a go fill in the rest of the world.
More unestablished markets, they're out there. Unsurprisingly, our experience is not really any different to those that Nick has communicated. I think just touching in on what Nick picked up on Lloyd's there, Lloyd's have spent a lot more time focusing in on the legacy transactions that have been taking place in that space over the last few years, somewhat after the horse has bolted. But I think that's positive, and as Nick said, we very much welcome that. We want this market to be seen as mature, and we want regulators to be comfortable with what's taking place there. Again, we've seen Lloyd's reporting their best result for a good number of years in the last week, and they will continue to clearly want to focus in on that, and I'm sure that will continue to drive more transactional activity in the Lloyd's space. Clearly, the business is staying in Lloyd's, and passing it from a live syndicate to a run-off syndicate doesn't necessarily change the overall result for the market, but we would certainly argue that the legacy players there were better placed to drive more value from those back year reserves, and therefore overall contribute to a better Lloyd's outcome. And that is certainly the position that we always stress with Lloyd's when then they are focusing in on in these lines of business. So US again, as Nick said, continues to be active for us. Certainly Riverstone has made steps into that market in the last few months, and we welcome the opportunity to be on board in that space. There is a big market, and there are clearly lines of business that everyone is going to enjoy focusing in on. But we do continue to believe, of course, that will continue to drive value. Likewise, as Nick said, Europe continues to really relatively disappoint compared to the quantum of reserves that are there. Be helpful to drive some value from that where possible. And maybe, David, I know you had some interesting comments about why that may or may not be the case when we talked about this the other day, which are always useful. So.
Sorry, which one again?
And on Europe, why it's quiet. So yeah.
I can't remember what I said.
You'll come up with something good. So. And again, from a rest of the world perspective, there has been more deals. We have seen more of them from a count perspective over the last 12 months, and we do welcome that. It's obviously a big step for the larger incumbent legacy players to move into certainly the Asia Pac area outside of Australia. There are some of the more experienced, and I mean, there is an IRLA Asia, and we know that some of the larger reinsurers are active in that space, and you know, their presence and their operational presence there is certainly, I think, the way that that market gets opened up and the way that that is led through. I think if we see the larger reinsurers there establishing those relationships, helping the regulators get more experience with what's going on in this space and driving through some deal flow, that will make it easier for the specialist and niche legacy players to move into that space over a period of time. Obviously, that comes with some operational challenge, and I think the deal structures there are much more likely to be sort of the structured reinsurance ones that we talked about earlier in the first instance as the market starts to move into that space, and certainly one that we can continue to keep an eye on. So,
Raeesa, any comments to add to those?
Not very much. I mean, my only observation would be that there have been, over the last few years, a few sort of life transactions in the life space for legacy players. So my only observation there is that people are living longer. So there may be more of those transactions to come, particularly in Southeast Asia. So that market might be more buoyant for those types of transactions.
Right, have you remembered your brilliant answer? You don't? Anything to add, though?
Did I say something mean about the European regulator or something? I don't remember. This is during our prep session. You'll have to remind me after the presentation. So whatever it is, I don't have anything that clever to say. I would say, as a growing broker, we've made investments in Europe recently, which some of you may have heard about, but also directly in the Netherlands in terms of what you're saying about life. We're obviously in Bermuda. We've got legacy operations in the U.S., and I can think of at least one deal that's waiting to be done in Asia Pac. So, but you guys, the practitioners, just have a much better finger on the pulse of deal flow than me. But we're investing in those areas where we would like to do these transactions with you.
Thank you, David. And the final question for the panel is, obviously the legacy industry is not static with all this movement going on, and I think it would be good to reflect on what the legacy industry is doing to make sure it is attractive both to its capital providers and its cedent market, so it thrives as the market changes. Maybe Raeesa will kick off with this one.
Yeah, sure. I mean, I think the legacy market is very attractive for capital. You've got a lot of PE interest in legacy, and particularly reinsurers. So they are willing to invest, willing to provide capital backed for legacy to provide solutions. The other point I would mention is that going forward, I expect to see more interest from my own PE clients. I've already been approached by several PE clients to basically say, can you recommend legacy providers where they would be taking or interested in taking investment? So it's sort of looking to facilitate those introductions. And that's something we can do. If there are any legacy players at the moment in the room right here that would like any introductions, we can facilitate some introductions. There is a lot of interest.
Good. Andy?
Yeah, thanks, Kevin. I mean, I agree with what's been said. You know, we obviously believe that this is a very attractive space, and we continue to see capital flowing into it. I mean, the focus from our point of view as we continue on in our journey under our current ownership is around sustainability, and I think sustainability for the market in general is something that's really important. You know, that involves significant amounts of medium and long-term planning, which you know, look much further beyond just the next deal. You know, it constant. You know, there is a degree of constant pressure in this space to continue to write more business, but you know, thinking about how you operationalize that and how you build out for that is really important to make sure that we are strong financially and we are strong operationally, so that we're able to provide, you know, the best service to our clients and provide that long-term solution that we all seek for. And that really starts with two key things for me. You know, we have to invest in our core functions and operations, and you know, I think that's something that the market has been very good at in recent years. We continue to embrace new technologies and look at how those strategies can support us. Moving forward, you know, we continue to think about systems and how we build those out and how we continue to, you know, be around for the longer term view, and also how we take a holistic view of the balance sheet. You know, we are both specialist asset and liability managers in the legacy space these days, and I think it's really important to continue to, you know, have the expertise and the knowledge and the contacts to allow us to focus in on getting as much value as we can from both sides of the balance sheet. And then the other thing I would talk about here again, and something that we've talked about at earlier panels before, is people and talent. It's often said that the depth of talent in this space is lacking, and that is something that we would sort of fundamentally disagree with. We think that there are a lot of strong people in this space and a lot of strong executive management with a real depth of talent and pipeline coming through. And it's been really positive to see, like IRLA really embraced that the Future Leaders program. And I think some of those things are super important to making sure that we're sustainable here. Certainly from where we sit, we've spent a lot of time embracing market-wide initiatives on succession and development as well through Lloyd's and through other agencies, and also just internally making sure that we have really got that lens in on succession planning, and that we're developing those skill sets that we will need to keep us around for the long term.
Thank you, Andy. Nick?
What's left to say? What attracts capital to the market? Obviously, it's the right platform, but it's also the market opportunity. So we've talked about that quite extensively. Andy, I can see you're in the room, so we've got 1 trillion to go for. We're working as hard as we can. But with the nature of the deals, we talked about kind of long-term partnerships and positioning for that to really start to get into relationships where we can access repeat flow. And that's something that any capital provider likes, right? I mean, we're a lumpy market. We do deals. We don't grow through underwriting motor policies day in, day out. So we have to do deals. And if we can kind of secure long-term relationships where those counterparties come back to the well every year on some kind of frequent basis, that's going to be supportive of an investor story. And then I think it's just around rallying, what are the real critical success factors of our market? What are our core competencies? It's our expertise. We are experts at packaging and taking on risk, and we need to be continuing to develop our track record and really trying to hold on to our kind of underwriting disciplines. We're creative, and we talked about that. The market has evolved significantly. We need to keep on chasing the next opportunity, but fundamentally developing our solutions to meet the evolving demand. The demand is changing. We need to anticipate that and really work back to continue solving a range of solutions there. We focus around best-in-kind liability management and asset management, and that balance is key when looking at our balance sheet and running that off successfully. And then fundamentally scale. Scale, I think, is becoming more and more important. It's an industry where economies of scale do play out in terms of access to capital, in terms of operational scale. So just rallying around those core competencies I see as critical for the ongoing success of the market.
Thank you, Nick. David, anything to add?
Yeah, so you guys obviously are, again, much closer to the deal flow, and you see a lot more transactions than I do. But for me, if you're a cedent, by the way, the legacy market that we're in now isn't the distressed runoff market that we've been in the past. So most of these transactions, and you can correct me if I'm wrong, but most of the ones that I see are about value creation and value enhancement. So if you're a cedent, it's really, and I'm saying this as a broker, it's important to be able to quantify the value of the transaction, and not just in terms of, rate on line or loss ratio, but in terms of cost of capital. How does an ADC alter your cost of capital? How does it lower your forward earnings volatility? What does that mean for your WACC? What does it mean for your share price? That's the type of conversation that seems to get cedents interested right now, particularly if they're trading, at or below book. So that's one thing, quantifying the value with the cedents, but then getting the capital providers interested. You talked about repeat flow, but the obvious thing now is, I think somebody said earlier, about the float. And again, since that fateful spring of 2022, when the yield curve inverted, we're in a completely different environment from the perspective of PE when they get this premium, how they can invest it and how they can leverage it. So the interesting thing recently was that the short end of the curve was really high. Last week, the 210 spread just went positive again for the first time in about 2 years. So that's going to alter the dynamics of how PE think about how they reinvest the float. And that's actually quite attractive as well, because as the yield curve steepens, you're going to be able to do medium to longer duration transactions and asset liability match them at a higher yield. So that's going to be interesting. And that'll change the dynamics of the market too, and it might facilitate more deal flow. But that's all I can think of at the macro level.
Thank you very much, David. Are there any questions from the audience? Mr. Corver.
Obviously, as past IRLA chairman, someone has to start the questions going. It's been touched on a couple of times about capacity in the market and the need for potentially. I'd like to ask: is there a need to show that there are players that are taking in the $10 million deals alongside those that are doing the billion? Does it create the wrong impression if only the press is reporting on the large deals? And we've obviously seen a lot of exits, and any comments I might have on R&Q, I'll say for when I'm not being recorded. But any comment on the panel for getting a broader perspective of companies that are willing to do the small deals alongside the large ones?
I don't mind answer that question. So I think, Paul, I think the market is beginning to show some signs of bifurcation. I think the market is moving towards some bigger, stronger players, and I think that's right, and I think that meets the needs of cedents. But I also think there's actually also room for smaller players to do smaller niche specialised deals, and I think we'll see people who are successful and being successful being in niche areas and niche smaller deals. But I think the market will tend to split apart a bit. And my sense is actually some of the work we've been doing recently is I expect there'll be an awful greater capital to come into the marketplace to support what this industry can do for the live marketplace. So I expect more will come in. What we probably could do with more coming into the existing players rather than creating more players coming into the marketplace than we get to the situation we were in a few years ago. That's my view.
Yeah, I think we've never said we wouldn't ride the small deals, and we do look at them. And but I agree with Kevin. I think there are often going to be players who are better placed to deal with the smaller transactions and the larger transactions. And I think that bifurcation just almost becomes inevitable in some ways, because that is going to be the way that capital wants to flow, and there's only a certain amount of transactional activity that anyone can really manage in one particular period. So I think if small deals come along, then certainly I think myself and probably Nick would certainly look at them as well. It's just that sometimes we're not best placed to write those deals, and I think it's perfectly acceptable that the smaller players who will continue to offer a fantastic service and support the market are there to do that as well. So
I don't know if we need to report on them more. I mean, I understand that it's annoying that the big ones only get in the headlines, but actually for a lot of these deals, it's the anonymity of the deal that gets it done. So the big guys would prefer not to report if they could avoid it some of the time. Maybe that would help deal flow. I don't know.
Yes, certainly.
We'd like to know, compared with India and China as a large population, and compared to Africa, the microfinancing plan. Do you have something on how would you handle that microfinancing? Because a lot of populations, they don't have insurance plan. How would you bring that into?
So that's a really good question, and we in for example the property market, we've tried to introduce parametric technology in Africa, particularly around distressed areas, because if you are in a population with lower income per capita, this is a luxury, and there's much lower levels of insurance penetration. In terms of how the legacy market functions in that environment, it really does need to be, especially if you're getting into the the countries outside of the OECD 25, if you will. Probably has to be a public-private solution a lot of the times initially to get the work done, and I've actually never seen anything like that in the legacy market. For example, in Africa, I don't know if any of you guys have or are more experienced, but it's an important issue, and one we should think about more. I don't know, Raeesa, if there's any scope around the ESG regulations that you were talking about in this area. Maybe not. The other thing is the demographic pyramid in Africa is completely different, and the life accident and health transactions would be totally different were we able to achieve them.
So with China, how do you see? China has advanced so much in several technologies.
Well, in China, there have been legacy transactions that have taken place at scale, and there's a deal right now that could get done quite soon. But I don't. You mean how is it different in terms of China as a economic player now and coming?
Because India and China, the insurance world with
Yep.
going on,
The Indian regulator has, I think, recently removed the requirement for local ownership of.
Your group has done anything in?
No, mine not. I haven't. I don't know about China, but not in India. Have you guys done anything in those regions recently?
Not actively from a
No?
legacy
No?
perspective.
Yeah, I'm not aware either. No.
It's a great point though, and it's an important one to address because we sit here and I was drawing a picture here when you guys were talking about jurisdiction, and I drew Bermuda, London, the EU, Zurich, the USA, and Australia, and actually that's a fairly narrow view of the world, isn't it? Yeah.
Any other questions, Andy?
I was just going to ask the panel, after R&Q's exit and Nick, your deal coming up with 6th Street, no more kind of listed legacy acquirers. Is that kind of what we see for the future, or do we see people kind of going public again in sometime down the line?
I have no idea. I think that the public markets are been sometimes a challenging place for the legacy market because it is a very bespoke sector. There hasn't been, to date anyway, a depth of comparables. Stocks tend to be fairly thinly traded by virtue of how they've kind of got there in the first place. So there's a backdrop there, which is, it's been challenging to tell the story to the kind of broader market, capital markets, that is. As the market grows, as the market matures, as we develop our proposition and we look, a few years down the line, that could well change. Some other players might have developed and grown, and the public markets might be a viable exit at that point. But I think we're not, we've just come out of the public markets for various reasons. We're comfortable that private ownership will support the next iteration of our journey, but who knows what the future holds. I don't have a very robust answer on that, I have to say.
I'll just add to that. I agree with Nick. I think what we've seen is that public markets are completely flat at the moment in terms of work coming in. DWF is also delisted, so we are putting more faith in private markets rather than public markets. I think what our CEO said at the time is, however well we do in terms of revenue reporting or whatever and growth, it's never reflected in the share price. So hence the delisting. Nick, I completely agree. I think it's currently a bit flat at the moment, but there may be public markets become an option in the next 5 years or so.
Yeah, I would agree with that. I don't think anything is imminent, but I think that the general lumpiness of this marketplace makes it a difficult investor story on the marketplace. But also, there's plenty of other capital around to invest in this industry, right? So I think they're taking that advantage of that. Yeah. Nothing to add, David?
No.
Okay. Any other questions? Or one more, Barry. Go on.
So I think we talked a lot about expanding the toolkit and different situations where you guys would like to be even more relevant. And David, myself, plenty of others in the room, are increasingly being asked about situations which perhaps the legacy market has not played in before, but perhaps we think, and maybe based on discussions with you guys also think you can provide some support. I don't know enough about who's in the room to understand whether there are regulators here, but do you think the regulators are going to provide the kind of collaboration that you're going to need to step into areas that perhaps you've had less experience of, where your risk appetite is there? Is the regulator's appetite for the legacy market to get into these sort of other areas also there?
I don't think you can bucket the regulators in one, is what I would say, Barry. So I think it depends on the regulator that you're referring to. And again, I'm not going to name specific regulators given that we're being recorded, but I think you probably know who I'm referring to. So, and I think that's true. I mean, generally speaking, I think the legacy market has a very positive relationship with regulators, and I think that applies across all the markets that we've talked about today. Yes, there's challenges that come up at times, and some of them will work in different ways, but ultimately, I think that certainly some more than others will see the value of what the legacy market provides to the insurance space and how it helps them with their regulatory objectives and how we can help them achieve that. And I think to the extent to which those relationships remain strong and positive and people work in honest and transparent ways, then yes, I think that we can certainly rely on some regulators to try and support us move forward if we want to change things up. So.
I was just going to add to that I literally just completed a deal early August where the regulator had to step in, the unnamed regulator had to step in, and they took an incredibly commercial approach, which was music to our ears and to our clients' ears. So I think never say never. There are some regulators that are willing to support transactions to get them through, particularly in the legacy market. So yeah, I've definitely seen that.
I would say that from a top-down perspective, regulators often react to trends. And so I think Raeesa mentioned earlier the ESG aspect of things. That could create opportunities for transactions. The changing demographic pyramids in the West, that will potentially create more incentive for life legacy transactions, and the regulators will be aware of that. And then one transaction that one of my colleagues proposed to a cedent recently was just based on, in her country, the inflation and interest rate volatility and a sudden asset liability mismatch in their very plain vanilla P&C portfolio. Regulators in countries like that are going to want to have more legacy solutions. So those would be three areas where maybe macro trends might affect regulatory participation.
I'll probably just add that, regulators are all very different. Some of them are keen to have a collaborative approach. We've seen some regulators that quite like it when we test something in advance of a deal, so they have the opportunity to think about it. Let's remember that they're learning as well, some of them, so they need to be taken on a journey. But it is very much jurisdiction specific, so you're going to get a different answer in different markets. And at the end of the day, you just need to satisfy, beyond the learning, satisfy from their standpoint, strong prudential management of the balance sheet, operational resilience, safeguards around conduct. So all of those basics that regulators look for, as long as you can prove the right home for the business part of an evolving business model, then I think there is there's a lot of road to spend that time.
Just to add to that, Nick, in my recent interaction with the regulator, I tend to find they were getting more pragmatic, Barry. I think which is helpful and good. They still have their guide rails, but they will listen and be pragmatic. But I think a quick plug for earlier here. One of the reasons we set up IRLA Bermuda was to give the legacy industry a voice with the BMA, because they wanted a sounding board, something to interact with the association. So if you feel that the IRLA can help in any jurisdiction around representing the industry to help open up or corridors with regulators, just ask us. We can use these associations to do that for the marketplace. Go on, Tom.
And do the panel think that there are concerns from regulators about private capital supporting businesses, particularly private equity? I mean, it's obviously connected to the last comment, but I sense there is some concern about the length of the time frame, the investment capital, the backing if things go wrong. Obviously we've kind of seen a public company exit, but I'd just be interested in your views across the regulators in terms of their view of the capital, and obviously with Enstar moving to the private market.
I think we definitely saw this a few years ago, didn't we, when we had that big flow of private capital coming into the space, and there were the challenges around there, and I think IOPA issued the guidance around legacy runoff around that time when they were having concerns about how assets were going to be invested and the like. So certainly our experience would be that the regulators are always keen to understand what capital was thinking and where that long-term capital position sits. We're always keen to remind them that, just as you just kind of alluded to it, Tom, just because it's private capital doesn't mean it's any more short-term than public capital. And I think that that's an important point for everyone to stress.
Do you think they buy that?
Well, not always, no. But the thing that never works for me really is that private capital is coming in to make good money, and it doesn't want to leave an unsustainable business behind. It wants the business to be successful, and leaving behind something that is unsuccessful is clearly going to be a failing for them and their exit strategy. So, that's what we're always keen to stress. Whether or not you could get that through to the regulators all the time or not is somewhat debatable. But I think if anything, PE can sometimes have a more strategic focus on what it wants and where it's going and how it's creating value, and I think that's important thing for this market and the people that are backed by that capital to continue to stress. So.
It's harder for the regulators to step in and save some PE firm than it is for them to step in and save, for example, a national insurance company, which is a national champion. And I think that a lot of it's just emotional when it comes, but yeah, it's a matter of convincing them, as Andy says.
I would also add that you're right, Tom. They do tend to ask the question, but actually, I think PE and professional investors have brought a lot into the industry, a lot of discipline, a lot of structure, and actually they want to leave a better asset than they bought in the first place, right? So there is an alignment here to improving things, not a negative situation. Exactly. We have to keep repeating it. Any other questions? I think we're.
Have you done any countries where the regulators have come on your way to advance your programs? As you said, Bermuda is able to help in other ways. So have you done it in any 4, 5, 7 countries what you are there, and the regulators are coming on your way?
Not as an inbound to a certain country or a certain regulator. I think the legacy industry is already in that country, and we're just helping the regulator or interacting with the regulator where legacy already exists.
So you are advising the regulators?
I'm not. No. No. As an association, we can represent the industry in front of the regulators, as an association.
Also in microfinancing?
Not in microfinancing, no.
Not in microfinancing.
Any other questions for anybody? I think we're done. Thank you very much for attending. And thank you to the panel. Thank you to the panel.